So Markus asked me to talk about new Keynesian macrofinance, and I don't think it's a well-defined term, but broadly, in terms of what Markus defined yesterday, in terms of macrofinance, somewhere intersection between macro and finance. We care about macro outcomes, but we think about finance type of mechanisms like risk premia, risk, potentially financial frictions. So maybe new Keynesian macrofinance might be something where you have risk and risk premia, but where the macro outcomes come at least partially from aggregate demand externalities as we typically have them in new Keynesian models. So what I'm going to do today is not really present a paper. It's more like a teaching talk, but it's based on a paper joined with Sang Lee, who was a PhD student here and who is now an assistant professor at Imperial College London. So let me start with some questions. And let me start with some maybe a little bit more boring questions, but given that this is at least in parts a modeling workshop, let me start with modeling questions. So the first is, how do we incorporate the standard new Keynesian price setting frictions into the type of macrofinance models we have seen yesterday and that the literature has used in continuous time? In particular, usually in these models, we have capital, we don't have labor. In most of the Keynesian model, we have labor. And we usually have this AK technology, so that in a short time period, your output is fairly fixed. And we will see that doesn't quite work well with the standard way of how we model new Keynesian friction. So we have to put something else in these models. And then what might be the implications of doing that to a specific model? That's a safe asset model that Markus briefly talked about yesterday. This would be the one country version of the model that Markus talked about. And then there are some economic questions I at least want to talk about a little bit, and they're partially from my paper, partially not from my paper. What are the implications of, well, risk or risk premium shocks? That's a catch-all term for all type of things that move risk premia around and potentially asset prices for aggregate economic activity through this new Keynesian demand channel. So how do these shocks transmit to the real economy, and possibly how can policy, particularly monetary policy, affect those? And I will do that fairly slowly. I will start with a setting where we have sticky prices, but I won't go quite all the way to the safe asset framework from yesterday. But I will first go to a framework without safe assets. So there's going to be idiosyncratic risk, and that's going to move around, but there are no safe assets. There's just one asset capital, like in most of the models you've seen yesterday. For example, you can think about it as Magnus's model with just one sector. What happens if we put sticky prices into that? And the implications are going to be somewhat similar to this Caballero-Simsek paper, even though there is no idiosyncratic but aggregate risk. And then I'm going to add the safe assets to it in positive supply. That would be my paper, and see how the implications change. So as a short preview, particularly because in the end I anticipate running out of time, as everyone, if we don't have safe assets, then we will see there is this established result in the literature, and we will see it's not quite as robust as it appears in the literature, that these risk shocks may create demand recessions. So that's usually what empirically people try to establish, and then they build models, and then they say, I have these models where risk goes up, demand goes down, we get a recession. And with flexible prices, they usually claim it doesn't work. Now, it turns out it's not always the case. We need some more conditions for that to actually happen. Prices need to be very sticky, and we need to select the right equilibrium. In terms of shock transmission, there are really two equivalent ways of thinking about these models. One is the more traditional new Keynesian way of intertemporal substitution. And another way is more in terms of portfolio choice, that you think about portfolio choice between capital and other type of assets, nominal assets, and that is broadly aligned with what Caballero-Simsek called a risk-centric view of demand recession. So in a sense, there are two sides of the same coin, and I will make that a little bit more precise what that means in this type of framework. And we will see that monetary policy can fix everything. So if you move the interest rate in the right way, you can basically take care of these demand recessions. So they're not a problem unless you are constrained. So now we are out of the zero lower bound or any effective lower bound. So a prediction, if you take these models very seriously, would be that in times like right now, we shouldn't really worry about these risk premium shocks, because if the monetary policy makers don't make mistakes, they're going to take care of them. A slightly different view emerges when you put in safe assets. And I think here about government debt, like yesterday. We have large stocks of these government debt assets. They're nominal assets, so they might be linked somewhat to the price level. And if you put those in, you'll get a very sharp prediction. You always get a demand recession. So the all it depends is going to be dropped. In terms of shock transmission, we can decide where these views are fairly equivalent in this world, that it's really the portfolio choice between a capital asset and a safe asset that drives things, and not so much the intertemporal substitution, which is more the consumption savings choice. And we'll see that interest rate policy is not fully able to prevent a recession. So in a sense, these shocks would always be a concern. So the predictions are not starkly different, but in some parts, they are a little bit more sharp. The key reason for those differences is that we have these normal safe assets, and normal is important, and in positive net supply is important. Why is that? Normal is important because it means the value of the safe asset is going to be tied to the sticky unit of account, to the goods prices. So the value of the bonds is not going to be sticky in normal bond prices, so there's no stickiness in the bond price. But because the value of those bonds, they make normal payments, is tied to the sticky goods price, there will be some stickiness effectively in the asset price. And the other thing is there's positive net supply, so the valuation of those bonds is going to affect aggregate demand through a standard wealth effect. And that generates then interactions that generate these predictions. Okay, with that, let me go into the model. And I'll start with no safe assets. That's what I talk most of today. I will briefly talk about a safe asset model, and if I have time, probably I won't, I'll tell you something that's in the paper. Okay, so here's the framework, and don't actually look at it for now. Think about it as the model that Markus presented yesterday afternoon with one country, but without bonds, or maybe even easier, the model that Magnus started out with just entrepreneurial firms and no other sector and no labor. Okay, so basically you've got these households, this continuum of households. They have log utility for consumption. They're going to manage capital. Each of them manages their own firm, and they all get their own Brownian shock, like what Markus said yesterday. And that shock drives around their personal capital. It's independent across people. So there's idiosyncratic risk. And the loading of that idiosyncratic risk, sigma tilde t, might be time varying. And then these guys are going to produce, so they also can trade the capital. For now, I shut down investment, so there's a fixed stock of capital. You just trade it, and you get shocks. And it's going to wash out in the aggregate. They have, in principle, in these models, an AK production technology. So you have 10 units of capital. You produce A times 10 units of apples, but I just set A to 1 for simplicity. So you just have AK, and that would be it. The problem with that is if I want to put New Keynesian stuff into that model, is that in New Keynesian models, we shut down part of we want some price to not adjust anymore. But we want to keep valuation markets where we need prices to adjust to clear markets. So then we need something else to move so that we can still have an equilibrium. So that you have in all New Keynesian models. And usually what you have is that labor is on the supply side is fairly flexible in the short run. So usually that's how it works in these models. You have this flexible labor. So if the market doesn't clear at a certain price, then labor somehow adjusts. There are some incentives that labor adjusts, and then you still get clearing markets at a different level of supply. With an AK model, that's hard because you produce 10 apples. If you have 10 trees, and each of them produces one apple, and there's nothing that can change that. So what we do is we add utilization of your capital inside, and there's a cost. So U is utilization. If you crank it up, then you just produce more. And there is a cost to that. You have to put effort. Okay, it's a bit mirroring this idea of this labor cost, labor disutility in the New Keynesian literature. The difference between utilization and labor is that actually how much you gain from utilizing a capital depends on how much capital you have. And that will help us with tractability when you have these idiosyncratic shocks. Whereas if I really literally was to add a labor market where everyone supplies 1 unit of labor, then actually it would be very hard to aggregate this model. I will talk about this on, I think, 2 slides a little bit more. Okay, so that's the first feature. Instead of AK, we utilize the capital. But still, this is not output units, because then we have to feed that stuff through the standard New Keynesian production side, where there is somewhere some differentiated goods where firms have market power and set prices, and then at some point we aggregate those goods again and put it into a consumption basket, and that we eat. So that's why we have this complication. These agents are going to utilize capital, and utilize capital, U times K, I call capital services. Those are rented out to intermediate goods firms. They simply take capital services and transform them into differentiated apples, so say apples with some sticker on it. And those differentiated apples are then sold on the intermediate goods market and because they are differentiated, these firms have some pricing power, so they have a price setting problem. Then there's a final goods firm, it's all competitive. They just combine that into a CES aggregate, so they take the sticker off and just give you the apples, and then the households just eat it. So that's basically the production structure. But that allows us to have these firms that face downward sloping demand curves, and therefore they have a well-defined price setting. Okay? And otherwise, let me maybe walk you through the model elements again with that. So if these households, they have preferences over consumption and this utility of utilization, they manage this AK capital, but they have some choice in the short run to utilize it more heavily. That costs them effort, or to utilize this less heavily, then they get less this utility from utilization. Capital has idiosyncratic risk, and you can trade it. Then the capital services are sold to the intermediate goods firms. There's a price to that. This is quoted in units of Apple, and that's perfectly flexible. Intermediate good firms simply transform these services into goods, sell them to the final good firms. They transform it with a CES function into the final good, and then it feeds back to households who eat them. Okay? Capital in the aggregate is going to be fixed. And then one thing I didn't talk about, the sigma tilde t is going to be time varying. And for simplicity, for today, we just have two states. It's low or it's high, and it jumps with a certain Poisson arrival rate. You get a shock, then it jumps to the high state, and then with a certain Poisson arrival rate, it comes back to the low state. Okay, that's a model without safe assets. So let's solve it. First, there is the household problem. Looks as follows. Households maximize utility, have a standard net worth evolution. Their net worth is reduced by consuming, and what you don't consume grows at the portfolio return. And even though I said there's only capital as an asset, I will add a portfolio choice problem where you can also choose a bond, because ultimately I need a lever through which monetary policy can affect the household problem with a nominal interest rate. So you have to put a nominal asset inside there. But here that nominal asset is going to be in zero net supply. Okay, so your portfolio consists of nominal bonds. They pay you a safe rate of I minus pi, where I is the nominal interest rate and pi is the inflation rate. And then there's a return on capital that I will not tell you exactly what's inside for now. But it's a standard thing, dividend yield plus capital gains. And you're going to choose consumption. You're going to choose how much you utilize your capital. Actually, this U would feed into this return here. And you're choosing your portfolio. Optimal choices are fairly simple. Log utility, you consume a constant fraction of net worth, as we have seen yesterday all the time. Utilization effort is new relative to yesterday, but it should look familiar relative to these labor models that you've probably all seen in grad school. So you're going to equate the marginal cost of utilizing, this is a utility cost, that's just a derivative of this thing, with the marginal benefit converted into utility units. What's the marginal benefit? Well, in consumption units, you have Ki units of capital. If I utilize 1 unit more, I get Ki units more of capital services. I sell them to intermediate goods firms at PRT times KIT. That is the units of consumption goods I get more from doing a little bit more utilization. So let's convert them into utility units by multiplying by the marginal utility of consumption, which is 1 over the consumption. Okay? And then what you see is what enters here is the capital to consumption ratio. Okay? And that's going to be constant across agents, because everyone's going to consume Rho times net worth, and everyone has net worth that's basically Q times Ki. So basically, this is going to be constant. So everyone's going to choose the same U. So that makes this whole thing very tractable. If I had added labor to this model, then your own wage wouldn't depend on how rich you are. So then you kind of have a concern where the wealth distribution matters. Then it's hard to aggregate, and it's hard to study risk. Okay, so that's why we do this somewhat unconventional thing. Finally, there is the portfolio choice. Well, that's fairly standard. Let's say martingale method from yesterday. The return on capital, the expected return, is equal to the risk-free rate plus required risk premium. And there are two of them, because there's idiosyncratic risk, and that's the one I want you to focus on. So the amount of idiosyncratic risk to take, that's your portfolio weight in capital, times one of those sigma tildes, one of those factors in sigma tilde squared. That's the amount of idiosyncratic risk in your wealth. Okay, that's your price of risk, if you like. And then the other sigma tilde squared, sigma tilde in this sigma tilde squared, that's the risk of capital. So price of risk times risk, that's the required risk premium we want. And of course, the required risk premium depends on your portfolio weight. If you hold more capital, then your price of risk, your personal shadow price of risk goes up. And then there is another thing that I don't want you to look at, but for completeness it's there. That's the aggregate jump risk premium. And it's a little bit ugly because I have these jumps. It's nicer when you have Brownians. But in the end, jumps are easier to analyze because you just have two states. OK, any questions? There is a where? This one? Oh, so because this is in units of ARPAs, right? And this is in units of utility. But when you, so you're going to have a Lagrange multiplier here that, when you plug it in from your first order condition for consumption, you would get the marginal consumption utility. So that we equate the cost in utility units to the benefit in utility units. It's exactly the same as when you have a labor consumption choice. You usually have a Lagrange multiplier and a budget constraint. Think about discrete time. And then you plug in this condition that my marginal value of wealth is equal to the marginal utility of consumption. And then you get the consumption appearing in your optimal labor supply choice. It's precisely the same. OK, that's the household. Should be clear, I hope. So let's clear the goods market before we even talk about the intermediate goods firms. OK, aggregate supply in this economy is going to be UT times K. Okay, K is constant. UT, everyone chooses the same. OK, everyone chooses the same U. There's another ingredient for this conclusion, meaning that the CES aggregation of goods is going to be efficient, that there's nothing lost in the process. And that's going to be the case because we'll see all these firms are going to choose the same price. And by the way, this should be calligraphic piece. They're all going to choose the same price. So all intermediate goods are consumed in the same quantity. And therefore, the CES technology won't really matter. So it will be just as if we produced U times K final goods. Okay, so that is going to be aggregate output. And aggregate demand, because I don't have investment, is simply what people want to consume, which is rho times total net worth. And I call the net worth to capital ratio Q. But of course, here that's equal to the capital price. Okay, and I stick to that notation. Q is the total net worth to capital ratio, and QK is the capital price. In this model, they are the same. But later on, they will not be. Later, they will not be the same. Okay, that comes from aggregating individual choices. You put these things together, and you see this equation here, supply is equal to demand. This is what Caballero-Simsek called the output asset price relation. And basically, it tells us that to understand aggregate demand, so the right-hand side of this equation, what we need to understand is like aggregate asset prices, the wealth to capital ratio. Okay, this rho times Q. So let's do that next. So how do we get to pricing aggregate wealth? There are, I would say, two views or two ways of deriving an equation for that emphasize different aspects of the problem. So one is the more the macro financing approach that focuses on portfolio choice. And that's also the approach in the Caballero-Simsek paper. And then there is the intertemporal substitution approach. That's what you learn if you look at Ghali's textbook and you read the textbook. It will talk a lot about the consumption savings behavior. And these are, in a certain sense, equivalent in this model. Let me explain that. So first, the portfolio choice view. Let's start from the portfolio choice condition. It's this one. Okay? As always, let's ignore that term. Let's plug in the expected return of capital. So what's that? That's the dividend yield plus the capital gains rate. So the capital gains rate is kind of clear. It's just the appreciation in how much capital you get. And the idiosyncratic risk in expectation cancels out. That's why it's not here. And the dividend yield is just rho in equilibrium. Why is that? Well, you have seen yesterday it's A divided by QK, or here U divided by QK. But, you know, the goods market clears. So in equilibrium, there's this relationship here. Okay? And that's why the dividend yield is not going to depend on the capital price in equilibrium. It's always going to be rho. Basically, there is an implicit amplification mechanism here that when capital prices are low, demand is going to be low, then there's going to be firms sell less output, so dividends go down, and the dividend yield stays the same. So it's not that when prices go down, the dividend yield necessarily goes up. So keep that in the back of your mind. Then we plug in market clearing because the price of idiosyncratic risk and also of aggregate risk dependent on your portfolio weight. We don't have bonds in this economy. It's just a zero net supply asset. So market clearing is theta I equals to theta equal to 0. Everyone chooses the same portfolios. we plug that into this equation from 2 slides ago, you're going to get something like this. So you're solving it for the expected change in the value of assets, and it gives you something like this. There is a growth rate of assets that depends on the real interest rate, I minus pi, on the time preference, on sigma tilde squared is going to be the risk premium, and the time preference actually shows up because of the dividend yield, and then on this aggregate term I want you to ignore. This is one way to get to this equation. So then this here comes from the dividend yield, and this here comes from a risk premium, because it's portfolio choice. An alternative way is forget about portfolio choice. Let's do intertemporal substitution. Intertemporal substitution, consumption savings behavior, is guided by what's called the consumption-Euler equation, which says the growth rate, expected growth rate of your marginal consumption utility is equal to the risk-free interest rate minus your time preference. So if you do that, and you do a little bit of algebra, well, first of all, individual consumption growth is equal to aggregate consumption growth plus some idiosyncratic risk. Then you apply Ito to this term to convert consumption growth into marginal utility growth. And then in the end, you use that consumption, aggregate consumption, and the capital price are related 1-to-1 to transform it into an equation for the capital price, because I want to do asset pricing instead of consumption quantities, which we would usually do in a New Keynesian model. And then you get to the same equation. However, the interpretation is slightly different. Now, rho really is a time preference, comes from here, and sigma tilde squared really comes from the precautionary motive instead of from a risk premium. Okay? So it's a different view on the world. But ultimately, they are tightly linked. So basically, the constant consumption to wealth ratio transforms that risk premium into precautionary motive 1-for-1. They're tightly linked because we have just one asset in positive supply, and we're pricing it relative to another asset that's in zero supply. So when we price capital, we're pricing total wealth effectively. But if we look at the consumption evolution, so portfolio choice is how do you split your wealth that you save between capital and bonds. But bonds is really the only thing you have. Capital is the only thing you have. Whereas consumption savings choice is how do I split my resources into savings, which then go into the portfolio choice, and consumption. It's really the same thing. You just choose your capital portfolio. Okay? So that's why, in a sense, they're equivalent. And by the way, this is essentially what in a New Keynesian literature you would call the IS curve or the IS equation, except that usually we plug an output instead of the price. Okay, I hope this is somewhat clear. Then let's go to the final ingredient of the model, which is this intermediate goods firms. And that's really the New Keynesian block. If you have flexible prices, these are CES, monopolistic competition. You probably all know that. If not, homework, derive it. If you do flexible price monopolistic competition as a price setting problem, you're going to set your price at a constant markup times your marginal cost. Your marginal cost in real terms is the rental price of capital, and you pay the households. The markup depends on the elasticity of substitution, and your real price is your nominal goods price divided by the price of the whole bundle. So that's what you're going to do if your prices are flexible. Now, in equilibrium, of course, these two are going to be the same because the only J-dependent thing here is your own price. So everyone chooses the same price. So this ratio is going to be 1. So how that works is that in equilibrium, the marginal cost, the rental price of capital, adjusts that you earn that markup. Okay, that's flexible prices. Now, when you have sticky prices, and by that I mean, to be precise, Rothenberg type of quadratic price adjustment costs. When you have sticky prices, everyone is still going to choose the same price. It's not like Calvo, where some people can change and some people can't. Everyone can change, but you just pay this adjustment cost when you change your price. Everyone's going to choose the same price, but you have some smoothing motive. Instead of picking your price, markup times marginal cost in real terms, you know if I raise my price, I pay this adjustment cost. It's quadratic, so you want to smooth it out. So you raise your price only slowly, and only in the long run you go back to your target price of this constant markup. Okay? It gives you an equation like this, where let me call this target price in terms of marginal cost PR flex for flexible price, where you have this difference between the actual marginal cost and the one that you get in the flex price limit. And then you multiply that by some sensitivity parameter, and then you're adjusting into that direction. Okay, there's a backward equation, so you have to read it backward, meaning if the marginal cost is higher than the flexible price marginal cost, then this thing is positive. You get a negative sign, meaning your inflation is going to go down, which means right now your inflation is high, so you raise your prices. Okay? So there's some smoothing motive inside there, but otherwise it's the same idea as this. And this kappa depends on a bunch of parameters. It's often called a Phillips curve slope. I'll just work with this kappa for now. Okay? And then you do some algebra using market clearing and household choices, and you will see this rental price is going to be related to the utilization rate in equilibrium. Okay? So it's basically just an increasing function of the utilization rate. Now that's all fine, and you can do that, but for simplicity for today, let me just shut down the dynamics and let me go to a pre-Friedman and Phelps world where there are no expectations in the Phillips curve, and instead we just impose a static relationship between inflation and this marginal cost gap instead of a dynamic relationship. That won't change any of my conclusions, but it makes some equations easier. Okay? So that's how I make a little shortcut. How am I doing on time? Okay, good. All right, so these are the three equations. And this is not really the same three equations as in Gali's book, because I have split the usual IS relation following Cavallero-Simsack into two equations, the output asset price relationship and the dynamic equation for the asset price. In the usual textbook, they would combine these two and would write this as an equation for utilization directly. But here I wanted to emphasize that in the background, asset prices adjust. So this model makes predictions for asset prices once you think about it as capital instead of labor. Otherwise, it's kind of the implicit value of labor. Okay, so utilization depends on capital because of the wealth effect, the value of wealth because of the wealth effect. The value of wealth is the capital price, depends on the stuff I've told you. And then we have the Phillips curve that depends on utilization because that affects your marginal cost through the disutility of utilizing your capital. And it affects inflation. So you see with the colors how these equations here are linked. In particular, because there's only one dynamic equation, because I made this shortcut with the Phillips curve, I can put everything together. Writing it this way is more informative to understand the model, but to solve it, it's easier to just reduce it to one variable, one equation. So let me do that. Let me plug everything in. And in terms of which variable I write, it doesn't really matter because I can always use Ito to transform it into one variable or to another. I use U. Okay, you could also have used Q and you get the same equation if you replace all the U's with Q's. And then you get this equation. This is not particularly informative. This looks just at those, but if you combine them, you get this one. And this is just a dynamic equation for you. And then in principle, we can solve the model. We only have to do one thing. What's that? Someone said it, interest rate. Exactly, I haven't said anything about the interest rate. So of course, this equilibrium depends on the interest rate. You have to say something about how the interest rate is set. But once you have done that, we have a complete description of equilibrium, and then we can move on to solve the model. So let me make some simplifying assumptions to get closed form or close to closed form solutions. I'm going to assume, and I don't explain you how, but I just tell you it's possible, that, remember, we have a low-risk state and a high-risk state. In the low-risk state, everything is going to run smoothly. So we are going to have a situation in which the interest rate is such that the flexible price allocation is possible, and I'm going to select an equilibrium in which we are in the flexible price allocation. You can implement that with Taylor rules and whatever. I'm not going to talk about that. Okay? So in the low-risk state, there's zero inflation. Utilization is at its flexible price value. And the capital price is just flexible price utilization divided by rho. Okay? So everything is constant in the low-risk state and at its flexible price value. And I'm just focusing on how does the economy change when there's this risk shock and risk goes up. So let's look at a situation where the interest rate is held constant throughout that high-risk state. Okay? And I'm going to look for equilibria. Then if the interest rate is constant, everything is constant. Everything that's payoff relevant, everything that enters this equation here, except for U maybe, is going to be constant in a high-risk state. And the jump backwards, so these pluses, by the way, I never explained them, they are the condition on jumping backward. Where do you jump to? It's also going to be not depending on time. So it makes sense to look for an equilibrium where sigma tilde is your state variable and the only state variable. So where everything is also going to be constant in the lowest state. So that's in another equilibrium selection in the background is called a minimum state variable selection. However, this is kind of the most common thing people do. So if they write down Taylor rules, which I don't do here, then implicitly they do that too. They just also have the interest rate endogenous. Okay? I will not explain that in detail, but if you want to know more about it, we can talk about it in a coffee break. Okay, once I do these equations, or these assumptions, everything gets simple. Because now, this is going to be just the expected jump from the high state back to the low state. And it's just two numbers, right? Utilization in the high state minus utilization in, sorry, the opposite. Utilization in the low state minus utilization in the high state. I can combine that expected jump with that risk premium we have ignored so far. Then you get some term here that's much simpler than what we have ignored. And then you get also the marginal cost, or here the UT that I plugged in, is also going to be constant within the state, and the interest rate is going to be constant within the state. And known, it's a parameter. So we really have one nonlinear equation for one unknown, the utilization in the high state. So that makes this very simple. Now let me make it even simpler by going to the fully rigid price case. In the fully rigid price case, kappa is 0. Okay? So when kappa is 0, then inflation is always 0. So marginal costs don't matter for price setting because you can't change the price. And that's the case that the Cavaliero-Simsek paper talks about exclusively. Let's do rigid prices. Then we get a linear equation for UH. We can solve that. I guess everyone can do that in the room. And under some assumption, this is a well-defined equilibrium, and it tells us something about how utilization in equilibrium moves in response to changes in risk and in response to interest rate changes. And of course, utilization, remember, is related one-to-one, is proportional to the price of capital and the asset price. So in a sense, it also tells us something about asset pricing. So here's some comparative statics graph to save us looking at the equation. So if you vary the risk in the high risk state and you increase it, then surprise utilization is going to go down and the asset price is going to go down. So higher risk means deeper recession and lower asset prices. And if you vary the interest rate, then if you lower the interest rate, you're getting higher utilization and asset prices. If you raise the interest rate, you get lower utilization and asset prices. And there are some notable boundaries. So one boundary is this one, rho minus sigma tilde squared h. That's what's called a natural rate. That would be the interest rate in the flexible price economy. If you put your interest rate there, you're getting the flexible price utilization, which is the same as in the low risk state. Okay? So in principle, if you lower the interest rate to that level, so I say lower because the interest rate is going to, the natural rate is going to fall when risk rises. If you lower it to that level, you avoid a recession. If you raise the interest rate a lot, or don't lower it enough, depending on where it was before, then you get to 0 all the way. So that happens when your interest rate is so high. So the only reason, we talk about this more in a slide, the only reason why all this matters here is because there's this expected return on capital, and when the capital price falls and utilization falls, then in some way the expected return on capital rises. And the expected return on capital you need to earn depends on the risk-free rate and some risk premium. But the reason the capital price matters is only because of the expected mean reversion back to the low state. Because the dividend yield, remember, was constant. It doesn't actually depend on the capital price. So lower capital prices by themselves don't create higher returns while you're in the high-risk state. They only create higher returns because you're expecting to jump back. Okay? So therefore, you need a high enough probability of jumping back. If you don't have that, you won't find any finite positive level of demand. So basically, then everyone starves and this economy collapses. All right, here are the conclusions for this model. No safe asset, rigid prices. There are 3. So risk shocks, meaning increases, transitions to the sigma h, to the high risk state, are going to lead to demand recessions. Demand below potential, and therefore you have lower utilization and lower economic activity. If the interest rate is larger than the natural rate, and because the natural rate you see falls if risk rises, that means effectively if monetary policy or if interest rate doesn't fall enough in the high state. So if monetary policy doesn't lower the interest rate sufficiently. That's the first conclusion. Then there are going to be these 2 equivalent intuitions that we walked through, you through them again, and why they are equivalent I told you already. So the portfolio choice intuition would be the risk premium rises, meaning the discount rate given an interest rate, prices are sticky, perfectly so the normal rate is equal to the real rate. When the risk premium rises and the normal rate doesn't change, the discount rate with which you discount future dividends is going to go up, right? Because you want a higher risk premium. So that means the asset price goes down And because asset prices are linked to demand, aggregate demand falls. So that would be more the portfolio choice way of thinking about the world. And the traditional way goes through consumption savings. Risk goes up. That's going to drive down, then you have a precautionary savings motives. So in general, you want to save in all types of assets in this economy more. And that's going to lower the so-called natural rate. And if the interest rate doesn't fall to that, then intertemporal substitution considerations tell you that you should eat less now and save more for the future. Okay? But in the end, these are equivalent. Monetary policy can fix things. We've just seen that. You lower the interest rate enough, everything is going to be fine. There is no recession. So everything is going to be fine means here only you fix the sticky price distortion. There's also monopoly distortion. You could have fixed that already with the tax. But I don't talk about welfare here. The only problem with that prescription is if there is a CLB or an effective lower bound or any other constraint on interest rate policy, you might not be able to implement. And then there's this large literature. Caballero-Simsek is not the only paper. There is, for example, this more DSGE paper by Basu Bandik. There's an earlier paper on the safety trap by Caballero and Fahy. There are some other papers that might not emphasize it so much. That whole literature basically says we need a CLB that all this risk stuff really matters through the New Keynesian channel. Okay? Any questions? Yes? The theta. Okay, let's jump all the way back to clarify that. So for you individually, you are one of those agents in this economy. You're going to choose your theta freely. It's your choice. You can pick any value you like. But because the bonds are in zero net supply, there's not really a positive quantity of bonds outstanding. In equilibrium, the average theta across all of us is going to be zero. Okay? That's just a supply assumption. And then because everyone faces the same returns, everyone's going to choose the same portfolio. So in the end, everyone is going to hold zero bonds. Does that clarify it? Zero net supply, exactly. We're going to change that in a moment if I have the time. Markus, how am I going? Okay. So let me be a bit quicker on what happens if we do partial price flexibility so that I get to the safe asset part of this framework. So remember, we had this equation here, and I've shut down this nonlinear term by making prices perfectly rigid. But of course, there is, at least in principle, another way of how markets can clear in this economy. If the interest rate falls, the natural rate falls, and normal rate doesn't react enough, if inflation were to rise, the real rate would come down and would restore some of these problems. So there is this other potential channel that inflation might actually help us. Or inflation might hurt us. If inflation becomes deflationary, then it raises the real rate even more and we get a deeper recession. Okay, so there's an interesting question here. What does inflation do? Does it actually make things worse or does it make things better? Now that is a little bit harder because now we have this nonlinear equation. So let me briefly, I won't solve it because I can't really solve it in closed form unless I make this a quadratic, but then the solution is ugly. So let me instead tell you how the solution structure looks like. So I rearranged it a little bit and put all u-dependent terms on one side and all constant terms on the other side. Okay? So, and if you stare at this a little bit, you see this has a convex, strictly convex if phi is not zero, and increasing term, and a linear and decreasing term. Okay, so it has to be U-shaped. Okay, and it's going to, because the linear term dominates when u is zero, and eventually it's going to go the opposite way. But we don't know where exactly it's located. So it has to be U-shaped. That means if there is a solution at all, there must be always one where it crosses this right-hand side from below. Because for high u, it needs to grow to infinity. Okay, so if there's a solution at all, it needs to have one solution where it crosses from below. But if for small u, the left-hand side is higher than the right-hand side, there could be a second solution where it crosses it from above. Okay, so that's the structure. So there would be something like the blue line would be the left-hand side. And for sufficiently high price stickiness, when kappa is fairly small, then actually you do get for small u, because this term is going to be lambda h when u is zero. For small u, you do get a large enough value. So if lambda h is higher than this side, which was an assumption we had before, then you will have a solution where you cross from above. Okay, you have the solution where you cross from above. That would be the first solution. And that would generate the same demand recession as under fully rigid prices. And that second solution is a little bit strange, at least from a Keynesian point of view. And it's always there. This is a nonlinear Keynesian model in a sense. This would give you an inflationary boom, where inflation actually makes things better. Now, it gets even stranger if I raise the Phillips curve slope, so I make prices more flexible. Then this part of the curve here goes down, and this part for large U of the curve goes up. Okay, it looks more like this red one. It crosses only once, and the solution looks like this inflationary boom. Looks like meaning it crosses from below, right? Does that matter? Because if you think about changing interest rates or changing risk, you're going to move this horizontal line up or down. Okay, and if it crosses from, suppose we move it up. So we raise the interest rate or we raise risk. If it crosses from above, that means your intersection point goes to the left. So you get a deeper recession. Whereas if it crosses from below, then your intersection point moves to the right. So you get a more shallow recession or even a bigger boom. Okay, so in one case, we get the same comparative statics as in this Keynesian world. Risk goes up, you get a deeper recession. In the other one, we get the comparative statics that's not like in the rigid price case. Risk goes up and you get a bigger boom or smaller recession. So here's the result, and I just very briefly go through it. You'll, under some assumptions, prices are somewhat flexible. You always have this, you sometimes have this Keynesian equilibrium, I call it, which is like the rigid price case, where the comparative statics are the way as in the rigid price case, as I just explained. And then there is this, I call this Fisherian equilibrium because it has this neo-Fisherian flavor where the inflation rate does all the adjustment. That always exists, unfortunately, and there things go just the opposite way. And to be worse, if prices are too flexible, that's the unique equilibrium. That would have been the red line before. So in a sense, we have to qualify the conclusions from that literature somewhat. If prices are too flexible, then actually you don't get demand recessions when risk premia go up. And even if prices are not too flexible, you have to select, in a sense, the right equilibrium. So in most of the literature, that happens automatically through the Taylor rule, but I just want to point that out. So there are some preconditions to get the conventional result in this model. The other two conclusions about intertemporal substitution and monetary policy can fix things, they can be rescued, but the intuitions are all upside down because everything moves the opposite way. Okay, that was the model without safe assets. So it has these, I would say, slightly strange features once you push it a little bit. And I want to tell you now how safe assets are in some ways a little bit more well-behaved, and at least I would say, but that's my bias, lead to a nicer story of how these demand recessions play out. There was a question. Markups. Well, so let's not talk about that. Let's talk about that in the break. And the reason is I just talked to Andre yesterday about that. I think we pay way too much attention when we explain the new Keynesian models on markups, because you can have the same macro predictions and change all the cyclicality of markups by moving the stickiness in a different place in the production chain. And you can write the model in a way that the markups are not there or very hidden, actually. So I think there has been too much attention on markups. That's my personal view. Probably most people disagree. And we can talk about it in a break, but I don't want to talk about it right now. Okay, let's go to the safe asset model. I think that's more interesting. So as a reminder, I told you about the model, and you probably forgot what's in the model. So let me just remind you what was in the model. So you have this continuum of households. They manage the capital subject to these uninsurable idiosyncratic shocks, and they decide on a capital utilization through this effort choice. We had this continuum of intermediate goods firms. They rent the capital from the households, produce differentiated goods. They set the normal price subject to price adjustment cost, and then this feeds into a final good CS aggregate as everything is competitive, and then it goes back to households, they eat it. So that's what we just had, and then we had this Markov switching between high idiosyncratic risk and low idiosyncratic risk. So that all stays the same. I'm not going to change that in any way. I'll just add one little ingredient to it. I add nominal government bonds in positive supply, okay? And those nominal government bonds are going to play the role of a safe asset, as in Markus's lecture yesterday. So remember, Markus talked about Andre, and I think it was Bernardo. I don't know who you are, but there was this trading between the two, and and that generated a service flow. so that these bonds have value even if there's not a lot of cash flow or no cash flow at all. So there are these safe asset service flows. And these bonds are going to be nominal, so they're going to be linked to prices. Okay, so that's the only change we make. Okay, let's do this quickly. So B is the nominal face value, the number of dollars outstanding in bonds. It grows at some rate. The government pays for now, or for this talk, a floating interest rate. So the normal interest rate is adjusted each period. And that means that the value of a bond is always, of $1 face value of bond is always $1 on the market, okay? Because the interest rate is floating. If we had long-term bonds, there would be also a bond price. We do that in a paper. Maybe Andre talks about it, but I'm not going to touch that because I won't have time. But it doesn't change dramatically the insights here. I call QB the value of all bonds in real terms relative to capital in the economy, and QK is the price of capital. So my Q, total wealth divided by K, is now QB plus QK. Okay, there's going to be interest paid on bonds, and how do we pay interest? Well, either we print more bonds or we raise taxes. So the government is going to tax capital, because that's another productive factor. It's going to tax capital to raise taxes, or it prints new bonds to pay the normal interest rate. You can divide by K, you can divide by the price level, and then this equation, this is the government budget constraint, becomes the interest rate is equal to the growth rate of bonds plus the ratio of taxes to the value of bonds per unit of capital. Okay, so this, because there's no government spending here, this is the ratio of primary surpluses to the value of debt. Okay, and I'm calling this thing S check T, so S for surplus, but somehow divided, normalized by the value of debt. And I would say this is the most interesting variable for bond pricing. Why? Because that's like the dividend yield or the payout yield on government bonds. So there are $100 of bond outstanding. The government pays $10 of primary surplus to all the bondholders. So the payout yield is really that $10 divided by the $100 of outstanding bonds. Okay? So that is the most interesting variable if you think about asset pricing. Okay, households have the same net worth evolution as before, except that now I call this the return on bond, but in equilibrium, it's still going to be I minus pi dt. Okay? But I just emphasized that. And now the theta is not going to be 0 in equilibrium, your question. Instead, it's going to be something else that depends on the ratio of bonds to total wealth in the economy. That's going to be the theta. Let me call that var theta. So that's the ratio of the real value of bonds divided by total wealth in the economy. In equilibrium, it's still true that everyone chooses the same portfolio. Okay? Therefore, var theta, this price ratio, is going to be equal to theta, which is the portfolio choice. And that's, so var theta you can also interpret as the individual portfolio weight in the bonds. And it's going to be positive if there's a positive outstanding quantity of bonds. So that's going to be the change in the model. Why does that matter? Okay, there are two things that this does to the model. The first is, and that's even true in flexible prices, these normal bonds in positive supply are going to provide us with a nominal anchor. So something, the price level is going to matter. In the economy before, the price level doesn't matter. So inflation matters through the Phillips curve, but at which price level I start this economy is completely irrelevant. Okay, so if I multiply all prices by 1,000,000 and I start the economy, you get exactly the same economy. The price level doesn't matter. Here it does. Why? Because the bond value is inversely related to the price level. So if you have $100 of bond outstanding, price level is 1 unit per apple, you have 100 apples of bonds outstanding. But if the price level is you have to pay $5 per apple, you have only 20 apples of bonds outstanding. Okay, so the value of bonds depends inversely on the price level. And bonds represent net worth because, you know, Ricardian equivalence fails due to these service flows. And that means if the price level is lower, there's more wealth in this economy, and people demand more consumption because they feel richer. So that's the idea why the price level feeds into goods market clearing and matters for this economy. So that gives you a normal anchor, even under flexible prices. The second thing is under sticky prices, the real quantity of bonds is going to be a state variable. Why is that, even though it's like a value or a price? Well, the bond stock, the number of dollars of bonds outstanding is naturally a state variable. It moves according to a backward-looking evolution, depending on how fast the government prints new bonds. It's a stock of stuff that's around. But the price level is also going to be backward-looking because of the price stickiness. Okay? Usually the prices would adjust and jump, but price stickiness prevents that. In flexible prices, that's different. Then PT and QTB are so-called forward-looking jump variables. They can adjust to shocks. But here, QT really is slow-moving, and it will only have drifts, and it won't have any jumps. So it's not just a state variable, but you could have a state variable that jumps, but the jump is kind of backward-looking. But here, it won't jump at all. So the shock comes, but it only has this drift because of sticky prices. And these two features will change some of our implications. And I guess I have not many minutes left. How many? Oh, OK, that's not too bad. OK. Backward and forward. So, well, I mean, you probably know what backward and forward looking is. And if you look at the terms backward equation and forward equation, they are exactly swapped. So forward looking means I have expectations. I look in the future, and my choice, usually these are choice conditions, depends on what I expect about the future. So mathematically, this will usually be what's called backward differential equations. So the forward-looking equations are backward equations, because you would solve them backward in time. From a terminal condition, you solve them backward in time to understand what you're doing today. Whereas forward equations, they are backward looking. Okay, so there's a state like a capital stock that moves slowly over time, or that moves over time, maybe not slowly, but it moves over time, and the stock of the past matters. The past accumulated capital matters for how much capital you have today. So that would be a forward equation because it looks backward in time. It comes from the back to the front. Does that help? Great. OK, so now let's go to shock transmission in this model. And here I show you first the graphs and then do the math so that you see what happens. And I will also contrast that then with the model without safe assets. So suppose this is time. Suppose we start in a low risk state. At some point, we get this Poisson jump to the highest risk state. We stay there for a while. And at some point, we get another Poisson jump, and we come back to the low risk state. So what's going to happen? The blue line is the sticky price economy with some parameters. And here for concreteness, I have fixed the normal interest rate to a constant value. So this, in a sense, the equilibrium here is unique because of the normal anchor up to some qualifications. So it doesn't really matter too much in terms of selection of the equilibrium, but it just is then very clear what the risk does as opposed to what does the policy reaction to the risk do to this economy. OK, what happens is, this is the flexible price level. Utilization output goes down. Okay, so get this, I would say, you get a recession, let's say. It's going to be a demand recession, but you get a recession. But then risk is still high. Nevertheless, output comes back. So it recovers on its own a little bit. Then you get this surprise, risk goes down. Well, then you get a boom. You get another jump. But then it kind of comes back on its own. Okay? Inflation mirrors that pattern because of that static Phillips curve that relates inflation to output. Then what happens with portfolios? So when the risk comes, there is what we would call a flight to safety. So people want to have more bonds in their portfolios. So the portfolio weight of bonds goes up, the relative value of bonds goes up. And it happens immediately with a shock. It stays constant, and when risk dissipates, it comes back down to the old value. The bond value, however, won't jump on impact of the shock. That's the sense in which it's a slow-moving state variable. It will gradually expand while we are in the high-risk state and want to hold this high portfolio weight on bonds. And then when we jump back into portfolios, it will come back down, also gradually. Of course, how does that work with clearing markets? People want to hold more bonds. The relative value of bonds has to adjust relative to capital. Well, the capital price is perfectly flexible. So the capital price drops steeply on impact. It gradually recovers. When we get a positive shock, the capital price shoots up, and then it gradually comes down. So you see there's a lot of movement in the capital price and not so much movement in the bond price, which we think is an attractive feature because if you look at reality, there's kind of a lot of movement in risky assets, I mean, more like stocks, physical capital is maybe, we don't know, but financial claims on physical capital, they move a lot, whereas these nominal debt claims, they don't move a lot. OK, flexible prices, this is the red dashed line for comparison. Utilization is fixed, okay, because output is fixed. People like to utilize at this flexible price level. Output is going to be fixed. Portfolios actually are exactly the same way. So when risk goes up, also in the flexible price world, people want to hold more bonds, and exactly the same. So this is not a coincidence. They are on top of each other. But how the asset market clears is very differently. The bond value just jumps up on impact. It stays constant. It jumps down when we get into the good state. And the capital value just jumps down, and it jumps back up. And the scales, I don't have numbers here, are the same. So this jumps up by exactly the amount this jumps down. So in the flexible price world, bond price and capital prices, in a sense, behave symmetrically. Whereas in the sticky price world, you see they behave very asymmetric. Okay, how does inflation move? Well, the bond value jumping up means the price level has to jump down. Okay, so there is a spike, a negative spike, negative infinity of deflation, or negative infinity inflation for one instance, but then it stays constant at 0 at the flexible price allocation. And then when the jump comes back, there's this spike, one infinite inflation because the price level jumps back up, and then it stays constant. So this is the dynamics of the model with flexible and sticky prices, but with the bonds. Now just a quick comparison, I will go a bit faster on that. The sticky price model with bonds versus no bonds. So the model I covered before. In that case, that's the purple line. Actually here with my parameters, you only get this Keynesian equilibrium, this Fisherian equilibrium as the unique one. So actually here when risk goes down, goes up, output's going to jump up, inflation is going to jump up, the capital price is higher as a baseline because it's the only asset in positive supply, and it's going to jump up too in the recession. And there is no bonds, so these graphs are at 0, so I didn't plot them. Now I can fix this. We saw how to fix this, that you don't get a demand recession. I could make prices much more sticky and select the other equilibrium once it exists. So let's do that. Well, then you get output coming down. Then there's no inflation because I made prices so sticky. There's a little bit of a drop, a little bit of deflation, but you don't see it, and capital prices come down a lot. So that's a prediction from before. But you see in that model before, basically by design, how we selected the equilibrium to some extent, everything is flat. So the recession comes and it hits you hard, and it stays like that until the risk dissipates. Whereas in this other model, where you have this bond state, things gradually get better, even if risk is still high. Okay, so this is kind of the key difference. Okay, yes? Let me defer that because now we talk about the mechanism. Now we go to the math. Math is usually more informative than the graphs, but the graphs are easier to process. 5 minutes? Okay. All right, very quickly, because Markus did that already, although I don't know whether you remember. So, and maybe he didn't do it as I do it. So if you think about portfolio choice, it's about relative risk, excess return related to, excess return related to excess risk. Okay, that's the relationship. You relate relative characteristics of different assets. Okay, what you are not relating is something that depends on levels, like total output or the price stickiness or so, unless they enter somehow, they enter the difference between different assets. But it turns out they don't. Okay, so what you get then when you do this exercise of portfolio choice, that this var theta, this bond portfolio weight, is going to follow an equation like this. You saw a similar equation yesterday, though it looked a bit different. I think this one is a little bit more informative, but I go through it quickly. So the share of bonds of total wealth in equilibrium is going to depend really on just two things. And I want you to note what's all not in there. Okay, there's no normal interest rate unless I put it in there through the fiscal policy. There is no price stickiness, no output, things like that. So what's in there is idiosyncratic risk. These are the service flows. So if risk goes up, people just like the bonds more because they allow them to self-insure. And what's in there is this payout ratio on the bonds. So how much the government taxes the capital holders and gives the resources to the bondholders. That, of course, drives a wedge into portfolio choice. If capital is heavily taxed and everything is transferred to the bondholders, you want to hold bonds, right? So that's in there. So this kind of that surplus to debt ratio, that's in there. But what's not in there is normal interest rates, output, things like that. Okay? So then we get a separation result that if this policy variable only depends on sigma tilde and possibly on var theta, but it doesn't depend on the bond value state, then the portfolio allocation will only depend on the exogenous state. Now I should qualify that or talk about that condition a bit. That doesn't mean that surpluses don't react to the value of debt. In fact, this is a surplus to debt ratio. Even if this thing is constant, you're raising more taxes as you have more debt. Okay? If I also allow it to depend on this sigma, on this thing, actually this nests very standard policy rules that people use in the literature, like linear feedback rules where the debt to output ratio reacts linearly to this, the surplus to output ratio reacts linearly to the debt to output ratio. So these type of rules are actually nested in this condition, and therefore this result is not just a small special case, but it's kind of something that would happen in many models if you had those safe assets. Okay? And somehow the intuition why this doesn't depend on price stickiness is that financial markets aren't sticky. So portfolios adjust fast. You get a risk, you have a purely forward-looking equation, you want a high risk premium, you hold more bonds. You don't care whether goods prices are sticky. Okay? Something will feed through the real economy, but when you make your financial decisions, you don't care about that fact. So in that sense, financial markets are fast, as fast as under flexible prices. Of course, fiscal policy could lean against that and prevent that flight to safety, but I want to study a case where for some reason they don't do it. In a richer model, it wouldn't be optimal to do it. They would want some flight to safety, but I'm not talking about that. I'm just assuming they don't do it so that when we transition to the high-risk state, there's a tilde missing, then bar theta goes up. Okay, now what happens? Let me jump over that. You can rewrite this output asset price relationship by noting that this relates, well, I'm not jumping completely, aggregate activity to the level of all assets, to the value of all assets. Whereas portfolio choice is about relative stuff, okay? Ratio of asset prices. So once you have the portfolio weight, you can write the level of all asset prices as a function of the value of bond prices and the portfolio choice. Okay, so basically I can write this QP plus QK as a function of QB, which is my state variable, and the portfolio choice. And then I get this type of output asset price relationship, which is the same equation just rewritten. Now, if we had flexible prices, you get the shock, more risk, people want to hold more bonds. That's a flight to safety. What happens to the real economy? Well, if you look at this relationship, then you see for fixed QB, bar theta goes up, so aggregate demand goes down. However, if prices are flexible, then supply is going to be constant ultimately because there's this optimal utilization level under flexible prices. So what happens? Somehow QB, which is a price, has to rise, right? Has to rise. How does it rise? Well, if you look at QB, it's a dollar number face value of bonds. That's not going to jump to clear market, but there's going to be the normal goods price. So goods prices just are reduced. And that makes also sense logically, right? This is goods market clearing. Demand is low. Producers see there's not enough demand. They cut their price to attract demand. So also the story of how you get to equilibrium makes a lot of sense here. Okay? So therefore, you get this downward adjustment in the price level on impact of the shock if prices are flexible. Now, guess what? If prices are sticky, that doesn't happen because it can't happen. Okay, so instead, portfolio choice tells you portfolio adjusts the same as under flexible prices. So the demand efficiency is still there. But QB is a state and won't move. So what happens is demand stays stuck at a lower level. Supply has to be reduced because otherwise you throw away your goods. You don't like that. So you underutilize your resources. So that's what's going to happen here. So utilization is going to clear the goods market. So we get this conclusion one again that uncertainty shocks create demand recessions. And here we don't have any qualification. As long as prices are somewhat sticky on impact of the shock, you get a demand recession. Okay, that's somewhat different to the other case where dependent on that prices are sticky now. Okay, now what happens after impact? And that goes back to your question. So after the impact, you get deflation, okay? And that is going to gradually increase the value of bonds. So you have adjustment pressure under flexible prices, prices drop. You have sticky prices, then not surprisingly, over time, prices are going to go down. Okay, so that's what happens. You see that in two equations. By the way, this relates to the so-called Pigou effect or real balance effect, which is an old idea that the value of bonds, because there's a wealth effect, depends on the price level, or the value of nominal stuff in general. It was originally formulated for money. Okay, there's this bond evolution, which basically says bonds change because the government prints more dollar value of bonds, it issues more bonds, or they change because there's inflation, so that or deflation, that the real value of bonds changes. Okay, so you can get this guy up either by printing more nominal stuff or by having deflation. And the second channel, the red one, that's the Pigou effect, that's related to this Phillips curve. You get too little demand. U is low, okay? Or QB divided by bar theta is low. You get too little demand. And that's going to generate deflation, negative pi. and that's going to raise the bond value. So that's the adjustment mechanism, how it comes back over time. Because you get these deflation pressures. As demand comes back, these deflation pressures get weaker. So presumably at some point you're converging to something where this becomes zero and you stay there. And in fact, you can solve this in closed form with a static Phillips curve, and you have this exponential minus something negative times t, so it's going to converge somewhere. And in the interest of time, I won't tell you more about this equation. Okay, let me maybe skip this one. So this is about, again, intertemporal substitution versus portfolio choice, and I can talk about this in the break if you like, if you're interested. It's really more about the portfolio choice side. The IS equation logic is a little bit confusing for this model. Instead, let's talk about interest rates. Okay, so how does the interest rate affect aggregate demand here? The portfolio separation, arguably a bit stark, because you know the fiscal side could react to the interest rate. I have shut that down in a certain way. Means that the safe asset portfolio demand is unaffected by the interest rate. Okay, so what happens is that the bond value is going to move gradually when you change the interest rate. And here with zero duration bonds, there's only one effect. High interest rate through the government budget constraint means you're printing more normal stuff to pay that interest liability, and that expands your bonds faster. Okay, and that's going to lead to a higher growth rate of bonds, and that to somehow substitutes for that deflation pressure. So you get a little bit less deflation because you're printing more normal stuff. So this Pigou effect gets weaker. But that's very neo-Fischerian in style. So you raise the interest rate, you get more inflation or less deflation. If you don't like that because you think that's not how the world works, it's not entirely clear, it never is like how the world works empirically, you can actually change the duration of the bonds, and then you get valuation effects of those bonds, and then that goes in the opposite direction. That's what we do in the paper, but I don't have time, so I won't do it here. However, even if you do that, you will not fully fix this result, that interest rate policy cannot eliminate the recession. Okay, so here it just can shift it over time somewhat, and it can't eliminate the impact effect. With long-term bonds, it can do something about the impact effect too, but it cannot completely eliminate it. Somewhere it has to accept the deflation in the output gap. 1 minute? Okay, what's the difference to the model without bonds? If you don't have bonds, and you look at these sticky price dynamics, the equations I showed you before, there was one forward-looking equation, a backward equation, and two static equations. If the Phillips curve had been dynamic, it would be another forward-looking equation. So there is really no state, I should say, I mean, there's of course a sigma tilde. There is no state that guides these sticky price dynamics, no endogenous state variable. So essentially, these are stateless dynamics because everything is purely forward-looking, and all you need to do is manage expectations to pick a nice solution to these forward-looking equations, that we jump to the right point. And it turns out in these models, usually monetary policy can do that job. Because, and that relates to what I skipped, with monetary policy, you move the level of interest rates, and that affects intertemporal substitution, but that's somehow equivalent to the portfolio choice. You can affect stuff, and it's all forward-looking, so managing expectations is enough. So these are the 2 points why it works. Here you have these bonds, and the aggregate demand depends on the safe asset state, the stock of safe assets out there, and that adds a new policy considerations. Namely, you want to manage the value of that safe asset state. And that's not just managing expectations. That also requires to adjust the stock of stuff that's outstanding that you have inherited from the past to the new conditions. Okay? That makes it more complicated. Let me skip that too. Last thing, and then I'm done. Now you could ask, how could we stabilize demand? And there are different ways how you can go. So one way is, we have this other instrument that I shut down, this surpluses or taxes. You could lean against the flight to safety by taxing capital less heavily when people want to have the bonds. Okay, you could do that, and then you shut down the portfolio allocation, and once the portfolio allocation is mute, once var theta is constant, the model almost behaves like a model where there are no safe assets. Okay, because in that model, actually var theta is constant at 0, and it happens if var theta is constant at a positive level. It's not exactly the same because you still have this nominal anchor, but in many ways it behaves the same in response to these. Basically, these shocks are shut down then. Okay? That's going to mitigate the flight to safety. In a richer model, it's not going to be optimal because actually we like the service flows and we like the bond stock to expand if there's more risk, there's more to be insured. Okay, so this wouldn't be an optimal policy, so you might not want to go all the way. You might only want to do a little bit on that margin. That's managing the demand for safe assets. You can also manage the supply for safe assets. And by adding some safe asset whose value is not fully sticky. So because effectively the bond value was fully sticky because it's tied, $1 of bonds is $1 of money, and the goods price, money versus goods, is fixed. So effectively the Apple value of dollars is fixed, of bonds is fixed. So there are two ways. One is the cheap way. You could have lump sum transfers in Texas, and the present value of those lump sum transfers in Texas, because they are risk-free transfers, serves as a kind of safe asset. And actually, there's something like a Cardian equivalence with respect to these taxes. And by changing lump sum transfers, you could absorb all the variation in safe asset demand for a fixed value of bonds. So the bond value never has to move. You shut down this kind of deflation pressures that come from this Pigou effect. In theory, that works just fine and can implement a lot of nice things. And the New Keynesian literature, when they actually added government bonds to the model, sometimes they do it, they always have this assumption in the background, lump sum taxes adjust, everything is fine. So if you believed you could do this, we wouldn't have to talk about this. But in practice, it's not really what we see, that governments use a lot of lump sum taxes. Some transfers, but probably not enough to fix everything. Or you could think a more realistic government debt structure with long-term bonds. And then if you lower the interest rate, you're raising the price of bonds, right? Because there's a duration positive, means the nominal bond value is interest sensitive to some extent. And then you can move around the value of bonds to some extent with the interest rate instrument. However, it turns out you can't control the interest rate and the value of bonds independently. And you also need the interest rate still to manage the transition after the shock happened. And that's something I can't go into, but you can actually still not prevent a recession. But then there's an interesting policy problem where you can ask, what is the optimal thing to do given that I can't fix everything? Okay? And that's something we do in the paper, but I won't have time to talk about it. So let me stop here unless you have more questions. And thanks. There was a question. Okay, so the question was whether if there's a tank model where there are some agents are hand to mouth, they don't hold bonds, they don't hold capital, they just eat what they get, whether there would be a dampening effect. And your intuition is what? I haven't thought about this model. Okay. 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 So the idea here was maybe the poor agents are not fully hand to mouth. They hold some bonds, but they are more risk averse. They like to have more bonds than capital, or maybe they can't operate the capital, Basar-Coco style, and they have a higher marginal propensity to consume. So suppose they have a high role to just fix ideas. And let me just give them only bonds and nothing else. Then you say because the bond value expands, they should want to consume more and that should stabilize demand. Well, on impact, no, because the bond value can move on impact. So on impact, it won't help, but it might be indeed that in the transition period, oh no, that's not entirely right what I say. So on impact, actually the experts, so the ones who hold the capital, they will lose because the capital price drops a lot. You've seen this here, right? That the capital price drops a lot. So we would have called that eta yesterday, would drop a lot, and therefore the demand share of these other agents is going to be much higher. They have a higher marginal propensity to consume. So to some extent, that would be stabilizing. That's correct. Okay? And then the second effect is that as the bond value goes up, you would imagine that then also these almost hand-to-mouth agents consume more and stabilize. That's not entirely clear because the capital value also recovers and undoes some of this initial effect. So I think that's something that probably would need to be studied. But it could be that you're right and there is a little bit of stabilization from these guys and not so much amplification as you might get in the kind of IS equation framework. I think we have to wrap it up. Yeah. Okay. Okay, thanks everyone.